Good morning, and thank you very much for joining us for the first of today's webinar. My name is Joe Litchower of Kepler Trust Intelligence, and today we'll be diving into the UK market, hearing from Laura Fole, Portfolio Manager of the Debenture Investment Trust, and also Dennis Jackson, the group's CEO. For those new to our format, here's what to expect. Laura and Dennis will speak for around 25 to 30 minutes, giving us an overview on the UK market, but also diving into the unique offering of the Debenture Investment Trust. After that, we'll move on to the Q&A session, which should last around 15 minutes or so. If you do have any burning questions you want me to put to Laura or Dennis, then please just drop them into the Q&A box on the bottom right hand of your screen, and we'll try to cover as many as we can towards the end. With that, Laura, Dennis, it's an absolute pleasure to welcome you both. Over to you.
Great, Joe, and thank you very much for having us on today. So quick run through the past performance, not a reliable guide to future returns. And we'll actually land on this slide, which is that Debenture, as Joe's hinted, is two distinct but complementary parts. Those of you know as well, you'll understand this, but those that don't, the bit on the left-hand side is what Laura and James manage on a day-to-day basis. That's the bit that's perhaps better understood about Deb. That's the investment portfolio. The bit on the right, as Joe just said, this is this professional services business, and we'll use this term IPS throughout this presentation. That consists of 18% of the net asset value of the company, but crucially, it's covered a third of the dividend over the course of the last 10 years. Put simply, if we can consistently grow the cash profits in the IPS businesses over time, then that creates more choice for James and Laura in portfolio construction, which we believe, and history tells us, will produce material outperformance versus the benchmark over time. It's also a wonderful two-way street. You can see the little bit at the arrow at the bottom is a two-way arrow. When we're going out and competing for business in the professional services business, it's incredibly helpful to be part of this 136-year-old, 1.4 billion market cap, FTSE 250 independent board business, because a lot of our competitors in this space might be privately owned companies or startup companies, and a lot of the transactions we do can be long dated. Let me just move on to the next slide. So just focusing on our returns table, these are numbers at the end of October. When we're committing capital, Laura will talk about this, but also within the IPS business, we're very much looking to the right-hand side of this chart. You know, we want to produce outperformance and capital growth versus our benchmark over time. There's nothing embarrassing about the left-hand side of the chart, as you can see very well. We're having a good year this year, but it's the 5 and 10 year side of our track record that gets us really excited. A few points to bear in mind about us. We've been trading over the course of the last 3 or 4 years, today being an exception, but at a premium to net asset value. So we've been able to issue 1.3 million of ordinary shares. And our ongoing charges ratio is relatively modest at just 54 basis points compared to an industry average considerably higher than that. But again, it's this point that by having the IPS businesses, it allows Laura and James the ability to invest in zero yielding stocks, which can be helpful to our overall performance. So we've got share price total return here on a longer dated basis versus some of our peers. The only competing criteria in here, these are people in the UK equity income sector that had assets over 500 million. There are other people that are in there, but as you can see, where we get the most excited is over that extended period. And if you, in fact, over 25 years, you know, we've outperformed the benchmark in 20 of those 25 years, so 80% of the time. And if you can think about all the different market cycles that we've been through in that time, to outperform the market 4/5 of the time is an excellent achievement. And obviously the returns that we've made are material. Just looking at the bottom slide there, you can see, and this is an important part of our journey, is the dividend growth. So if you look at the dividend growth since 2015, we've more than doubled the dividend in that time. And again, it goes back to this story of looking to grow our IPS businesses to support that dividend, and that's a crucial part of our combined offering. So I'm going to spend a few minutes now, as I say, we'll talk for about 25 minutes between me and Laura, but I'm going to spend about 5 minutes now just running through the IPS businesses. What gives us that confidence that we can grow the earnings from this business over time? So just like Laura runs a portfolio of stocks, we run a portfolio of businesses here. We break them out into 3 groups for the purposes of the annual report and external reporting. In reality, there's about 6 businesses that sit in here. And then if you drill down another level down, probably between 20 and 30 different underlying revenue streams. But what they all have in common is that they all have a high element of repeat revenue. So we think of about 2/3 of our revenues as being repeat. Even though that some of them might not be contractually repeat, I'll give you an example. In the pension trustee space, if we win an appointment there, the average length of appointment is about 9 years, even though contractually it's a here today and gone tomorrow appointment. We do tend to retain those over time. So we think of about 2/3 of our revenues here being contractually repeat. And if you looked at our net operating profit margins, they're about 20 in the high 20s%. So high margin businesses with strong repeat earnings. And you can see that at the half year this year, we grew our revenues by 7.7% and our profit before interest tax was up about 7.5%. As a target, the guidance we give to people is we look to grow the profits in this business by mid to high single digits, so 5 to 9%, and look to compound that over time. And we've managed to achieve that over the course of the last 8 years. So let me just drill down one level into these earnings. These are the half year earnings for these businesses. Actually, I'll stay on the previous slide for a second. The pensions business, so what does a pension trustee do? So pension trustee basically sits across private pension schemes. These were historically defined benefit. Increasingly, these are becoming defined contribution. Next stage will be collective DC schemes. And we're the independent trustee within those schemes. What we started to do is add other products and services around that, for example, arranging the meeting, taking the minutes, doing the asset manager, beauty parades, and so on. So that business is about governance within pensions. And the great thing about that, the pensions business, is that whoever's in number 11 Downing Street, and yesterday's no different. What happens on Wednesday in the budget is there are changes that come along to those to pension schemes that have to be implemented, and part of our governance is making sure that those changes get implemented. So there's a never-ending stream of rule changes in there that have to be made. The corporate trust business was why we were set up 136 years ago. So we act as a trustee between the issuer of a bond and the investors in a bond. And if that's all operating nicely, we're a conduit for information. There's a situation where there's a restructuring needed or a bankruptcy, then we become a mini law firm and we move to number 3 on the creditor list behind HMRC and the liquidator. And we only need to do work if we're secured or indemnified to our satisfaction. But we can earn significant incremental fees as we look to maximize returns on behalf of the bondholders against the company. So there's strong elements of counter-cyclicality in there. The other thing I'd say about both the pensions business and the corporate trustee business, they've got a huge amount of inflation linkage. So many of the contracts that are in here are on a very long dated basis for corporate trust specifically, and have RPI linked inflation, which we didn't really care about for the longest time, but then in 2022 became very important to our business. So counter cyclicality that's embedded within there, as well as elements of inflation linkage, which is very, very helpful to us. And then on the right-hand side, we've got a collection of businesses, our corporate services business, which I think at some point, some of the underlying businesses that are getting big enough will probably break those out too. But I'll highlight a couple of them now. I think the first thing I would highlight is our company secretarial services business. So that, again, has a mini portfolio within it. We do what we call global entity management. So think large car manufacturer in Michigan. They might say, right, we'll do all of our filings in the United States, but Law Debenture, can you take care of my filings elsewhere? And we'll act as that gatekeeper to make sure that for their X subsidiaries in Y countries, we keep all of those in good standing. There's another business that does compliance filings for folks in the UK. And in addition, we do board advisory work, more board advisory work in the UK, where we'll actually go into companies, minute their meetings, do action items, and some of the follow-up services that I described earlier in the pensions business. And we will be the named company secretary for a number of UK listed companies. We'll also help companies that are on an IPO journey there. Frequently, a company will start making money. Its governance, quite frankly, will be a bit of a mess. And as they go towards that listing route, they need help to sort out their governance and go on that IPO journey, and then receive director training about what their obligations are now that they're a listed company. So company secretarial is a business that we're very excited about. We're excited about all of our businesses, but it just gets shine. I wanted to shine a light on that. And then lastly, because I'm conscious of time, is just our whistleblowing business. This is a company called Safecall, which is based in Sunderland in the northeast of England. Traditionally, that was, as the name might suggest, it was a call. So people who had concerns about what was going on at their company would call in to our confidential whistleblowing hotline to raise concerns that they had, be these health and safety concerns or theft concerns on whatever they were. And these are manned by former police men and women that work for us. That's our USP. We get paid for that business from an annual fee perspective, and we've also started to add services around investigations and training to our suite of services there. But the great news is, with respect to whistleblowing, over the course of the last 6 or 7 years, governments all around the world have been bringing in whistleblowing regulations and whistleblowing best practices. So it's got something that has a regulatory tailwind, if you will, that's helping to really accelerate the growth within that business. So diversified portfolio businesses, how did they do in the first half of this year? I think we probably got an outperformance from the corporate trust business. You know, it's 136 years old, 17.6% revenue growth, doing particularly well because of our escrow product. So our escrow product is simply, most of you as retail investors will know what an escrow is from having bought a house. You have to send your money to the lawyer and your documents to the lawyer, and when everyone's happy, they complete the transaction. We don't do it for houses, but we might do it for an M&A transaction. We might do it for one of these enormous buildings behind me. We'll do it for a tanker, an aircraft, but basically anyone who's looking to transfer an asset with another party where they need some sort of verification around either the money or the documentation along the way. We also do it for sporting events, by the way. Everyone gets excited every time there's a World Championship out, because we've got a particular particular niche there where we work on that for purses at boxing matches. So again, a diversified pool doing very well. Pensions is just normalizing after a difficult period. There's nothing inherently wrong with that business. We all remember the short-lived trusts and government. That actually, the thank you note that will never be written, is that actually led to a significant improvement in defined benefit scheme financial positions over the course of a very short period there, which means there was a call to action during 2023 and into early part of 2024 to take advantage of your substantially improved funding position. So we had an amazing time. For those of you that know as well, we talked to the fact that when we were growing that business by over 20% during 2023, that was the perfect situation for that business, and our comparators were hard. I think what it's fair to say is they're proving after a hard period. I put in at the bottom of the chart here, you can see that in the 6 months from the first half of 25 versus 24, we actually increased our revenues. But when you look at it year on year, it looks like it's a tough time. So as a blended portfolio, up 7.7%. And I think then the point to make is diversified portfolio. We think we can grow our market share in growing markets, and if we do that well, if we do that by 5 to 10% and make real cash profits, Laura has more choice. So with that, I'll hand over to Laura.
Thanks very much, Dennis. I assume everyone can hear me. Give me a thumbs up. Yeah. Right. So for those who don't know me, my name's Laura Foll. I'm the joint portfolio manager alongside James Henderson, I've been the joint portfolio manager since 2019, but I've been involved in the trust since around 2011, and James has been managing the trust since 2003. So there's been a real consistency in how we've run it over that time period. And over the time period, the objective has remained exactly the same, which is to grow capital and to grow income. And the really nice thing about managing Lord Debenture is that, and I'll explain why, but it's that we can focus on growing the capital and treat the income from the portfolio as an output. So let me explain. If you sort of put yourself in the shoes of a traditional UK income fund manager, you have a relatively small pool of investments. So this inner red circle that you can see in the picture, this 92 shares, is me doing a very finger in air of, okay, so you're looking for probably more than a 3% dividend yield in the UK. And if you're a traditional UK income fund manager, you probably need a relatively large company. So I've just struck it as you need over a 3% yield, need over £1 billion of market cap. That only leaves you 90 odd companies to choose from. Now, some of these are very good companies, some of them have performed very well, the NatWests of the world, the Tesco's of the world, but it is quite a small pool. Now, with Lord Deb, the difference is when me and James turn up on day one of any year, we basically know that we've got a third of the income from the trust in the bag from Dennis's business, the IPS business. And that affects the way that we can run the portfolio. So that 90 odd list of companies that you could choose from suddenly becomes 350. Again, don't take these figures to be exact. This is very finger in air. What that 350 goes is basically, we don't need that yield requirement necessarily. We can fish in a much bigger pool of potential investments for Lord Deb because of the structure, because we're not chasing that specific 3.5% dividend yield to meet the benchmark. So what the table in the middle is showing you is the effect of that bigger circle. So the middle table just says, what are the best contributors to our so what has driven the outperformance of this portfolio over the last 5 years? Which individual stocks is it? This is to the end of June, but it would be very similar now. And if we look, Rolls-Royce, M&S, Flutter, Babcock, Applied Materials, all of those, if you look at the dividend yields that are listed there on the right, you can see that they're very low, comfortably lower than the UK market yield of 3.5. All of those would have been hard to hold in size in a traditional UK income fund. So you would have probably been able to buy Rolls, M&S, but it would have been hard to hold them in size and let them run up as they performed well if you were trying throughout that whole time period, 5-year time period, to be meeting that benchmark yield. But we were able to do that in Lord Debenture. And you can see there, we've got NatWest in there as well. It's not to say that there won't be good performers that are in the middle circle. And the middle circle, like I said, has some great companies in it, and it's 40% odd of the portfolio. But it's that we do have that extra choice that is enabled by the structure. And finally, if we look at just the table on the right-hand side, this is the yield, the dividend yield distribution of the portfolio. And all it's getting at is that we have roughly a third of the portfolio less than a 2% dividend yield. Now, that's very unusual for an income fund. And if you were trying to do that in a more traditional income fund structure, the way you'd have to balance it is that you'd have to stretch for dividend yield at the other end, so the above 5% dividend yield. Now, normally, it's when you're stretching for yield at the higher end that you run into some of the value traps, companies that are in structural decline, for example. So the nice thing about this trust is we can have that third that's in the lower dividend yield end. There might be some recovery shares, for example, but we're not having to stretch at the higher end to compensate for it. So that's the structure. If we then flick on to think about what is it we're actually looking for in a company. So the next, there we go, perfect. So what is it we're looking for? So James and I are value investors at our core. So traditionally for this fund, we would have a P lower than that of the market. For context, the P on the portfolio at the moment is about 12 times the market. It's more like 13, I'm rounding. And that would be pretty normal for us. We would have a P below the UK market. But I've called us pragmatic here. And what I mean by that is we're not just using one metric across the whole portfolio. So, for example, some of the things we're buying at the moment, we are buying on the basis of them being at a discounted book value. Something like IP Group, it's a percentile of the portfolio. It invests in healthcare companies, tech companies. we were buying that in September at about 50% discount to its latest NAV. So in that case, we were buying it off that metric. In some cases, we're buying on PE or PE on a recovered earnings number. So not the PE as it is right now, but on an earnings number that we think it could be in a couple of years. Or we might be buying on some of the parts. And what I mean by that is some companies are capable of splitting themselves up, and it's not always accurately valued in a share price. So something like Johnson Matthey, for example, one of our holdings, recently sold a division to Honeywell in the States. You know, ITV might be in the process of splitting itself up. It looks like Sky might want its broadcasting business. You know, AB Foods, which is the owner of Primark, might also be in the process of splitting itself up to Primark and then a food company. So we're looking at all sorts of different valuation metrics, not just one, and not just screening across the whole market. And in particular, I wanted to draw out recovery situations because I think the structure of Lord Ebb puts it very well placed to own recovery situations. And actually, if you think back to the table on the previous page, things like Babcock, M&S, Rolls, this is going back a couple of years, were recovery situations. And we were able to hold them in Lord Ebb because we didn't need the yield when we were buying them because of the structure. And coming back to something Dennis said, we had the patience to hold them. As in, for Lord Debenture, we are, like Dennis said, there's nothing to be embarrassed about our shorter term numbers, but that's not what we're driving to. We're driving to the longer term numbers. And when we were buying Rolls or M&S, we were thinking about the longer term recovery. We weren't thinking about the next 6 months. So this structure is perfect to be able to hold some of those recovery situations, and they have often been the best performers for the trust. If I were listening to this call, I would want to ask, well, what are the recovery situations that are happening right now? And if I were to say one area we're adding to, it would be something like the UK building materials companies, where obviously this isn't a recommendation, but that they've been under real pressure, some of these companies, partly because of the budget and interest rates. But these are companies where you can buy them at the moment on a lower than historic average valuation, on a lower earnings number as well. So the best performers over the very long term are where you can get both an earnings recovery and a valuation recovery. That's where you really make the money over the very long term. So I think there is potential, and who knows the time frame, who knows if the earnings will recover, but there is potential for something like that in some of the UK building material shares at the moment. So we're adding to some of those. We're focused on total return. All I mean by that is returns can be made in different ways. Sometimes most of the return will come from a good dividend yield, for example, for some of the insurers. Sometimes it will come from earnings growth, so say for the likes of Flutter, and sometimes it will come from a re-rating. And we're pretty agnostic about where that return is coming from. Like I said, we're pragmatists. And then finally, just in terms of the portfolio construction, we think of it as one trust. And what I mean by that is the IPS business, which Dennis spoke well about, that's 18% of the NAV. And you could think of the investment portfolio as diversifying away from that 18% of the NAV. So when you look at the top 15 in a couple of slides, you'll see that the weights are relatively low. And that's partly because we are very deliberately diversifying the portfolio. This isn't a short list, high conviction fund. It never has been. And I don't think it should be because of the structure. And hopefully the results speak for themselves, and it has delivered well for shareholders. We've given a case study there of M&S. I don't think we need to go through it. I think the key thing to just bear in mind is that the cost of it, we've more than taken out the cost of it, and we still have more than what it originally cost in the portfolio. Dennis always says to me, you need to talk about how much profit you're taking out of holdings. So if you just look at the bottom right-hand corner of this, all I'm saying is that's the key point. We spent $9.5 million buying that holding in M&S. This was during COVID, so it was about 5 years ago. We've already taken out 15 million. It cost us 9-ish. We've taken out 15. It's the holding is still worth, well, 12 when I did this slide. It's actually 15 million today. And we've had a very small amount of dividends along the way, but not a lot. I mean, so the key thing is we've taken out comfortably more than what we put in, and we've still got more. This is the value of some of these recovery shares if you are willing to be patient. Now we can click on. Just in terms of what we've been doing, we've been adding to the UK. I'm sure you've had a lot of fund managers tell you just how good value the UK is, and we're no different. We're about 90% UK weighting at the moment. We've been, the updated number of that 35 million is we've put about 50 million pounds into the UK this year. UK equities are trading at about a 35% discount to the rest of the world. And the follow-up question that I always get from that is, yes, but we don't have any tech, and we don't have any video and things. And that's totally right. But even if you adjust for that, every single sector in the UK is at a valuation discount to the US. So the one I always like to give, and I checked it was still right this morning, is you pull up something like a Walmart. I'm always just incredibly surprised at the valuation. Walmart is on 40 times earnings, actually slightly over. You look at Tesco, Sainsbury's, that have been very good performers in the UK. Tesco, I think very well managed at the moment, 15, 16 times earnings. Sainsbury's lower. You compare that to Walmart. Obviously, there's always reasons that you can't precisely compare, but that's a pretty astronomical difference in one sector, and that's replicated across every sector of the market at the moment. And I think just to sort of hammer the point home, we can see the takeovers that are happening. As much as people like me talk about the discount in the UK, I think it's proven by the takeover activity that we're seeing. So we own Spectris in this fund. It was bid for at an over 100% premium earlier on this year. That was the most sort of astronomical takeover premium that we've seen. But elsewhere, we've seen more like 25, 50% type premiums for the likes of Renault in industrial chain. We've had the likes of Epwin, which was door and window frames. So I think these takeovers show that the discount is real. It's not just people like me talking about it. There are real takeovers happening. If we then flick on, what are we doing? I think we've covered some of this. The UK consumer, for everything that it's had thrown at it, I'm sure someone will ask me about the budget, but the savings rate in the UK has ticked up really materially in recent years to more like 10%. Historically, it would have been less than 5%. What that means is that for the likes of Kingfisher, which is B&Q and Screwfix, and AB Foods, which is Primark, that actually the UK like-for-likes, so like-for-like sales growth is okay and fine, and actually the more challenging area is France, actually, for these companies. So as much as there has been a headwind for the UK consumer, the UK consumer actually doesn't look too bad compared to parts of continental Europe. So that's an area that we've been sort of gently adding to. Both Kingfisher and AB Foods would be on a low teens PE, which I think looks reasonable, perfectly good balance sheets. Commercial property, another area, that's 5% of the trust roughly now, or the portfolio that's in that area. Some pretty chunky discounts in there for an occupational market that's actually running pretty well, and we're seeing some good rental growth. We've put Shaftesbury Properties here. They're talking about high single-digit type rental growth from that very core London estate in the West End. And then I've mentioned the likes of IP Group, so I won't go too much into that. In terms of how we're funding that, we are reducing. I do think Tesco is a very well-run company, but it has, from a UK perspective, re-rated a fair old way. Shares are up over 60% in the last 2 years. It is a food retailer. It's still a very competitive area. You've got Asda sort of trying in the background to regain some of its lost share. So we've taken some profits there. And we've also taken some profits out of defence. Something like a Babcock was a classic recovery share 5 years ago. We've seen its earnings roughly double. We've seen its rating in terms of its PE multiple roughly double. So not complaining at all, but we're taking a bit of money out of that as well. And then we have obviously had some cash coming in as a result of some of those takeovers. So we've been recycling those holdings elsewhere. We then flick onto the portfolio. I won't spend too much time on this. The reason being that the top 15 doesn't give that much of a flavour of a portfolio that's 150 shares long. So I think if anyone has any questions on those, do give me a shout, but I won't spend too much time going into each. The question that I would have if I was looking at this particular slide is, it looks diversified with the exception of the 90% that's in the UK. And what I would say is that 90% isn't in reality 90%. What I mean by that is that this portfolio has roughly 40% truly in the UK. A lot of these big companies, the Shells, the GSKs, are not in reality exposed to the domestic economy. So the true exposure to UK PLC, if you want to call it that, is 40%. And that would compare to the benchmark of about 25%. So we would be a bit overweight domestic UK, but not anywhere near to the degree that that middle pie chart would suggest. And if we then flick on, and I think we're running almost exactly to when we said we would. We've got lots of time for questions. It's been a good year for the NAV. The NAV's up 25% odd. But even with that, the portfolio is on a PE of around 12 times. So I think there's still, what that probably goes to show is that this time last year, UK valuations were at very depressed levels. I would say they're still at depressed levels now, certainly compared to some other regions of the world. We need to take full advantage of that. And this is the structure that we can do it in. So I'll stop there and hopefully we'll get some questions.
Thank you, Laura. Thank you, Dennis. That's brilliant. And I think a really insightful update on the trust. But yes, let's jump into some questions. Dennis, I think you mentioned at the beginning that the trust typically has traded at a consistent premium. And I think that's supported in a reflection of the performance profile over time and also that recorded dividend growth supported by the IPS business. But more recently, and I think as of today, the trust is trading at a discount, 3 to 4%. Do either of you have any thoughts on why this might be?
Yeah, shall I start? The feedback that we've had, and certainly the UK equity flow data that I've seen that we get monthly, would suggest that October in particular was a month that saw UK retail investors pull money from UK equities. Now, there was a certain logic to that. Obviously, they didn't know what was coming with the budget. We now do. So I'm hopeful that will give, hopeful is probably the right word, that we get a bit of hiatus in that outflow that we saw from the market. So that was definitely the feedback that we got, that it wasn't necessarily anything trust specific, but that UK equities as a whole, we're seeing outflows. I would say the other bit of feedback that we've had is on, so this trust has a dividend yield of around 3.3, 3.4%. But as Dennis touched on at the beginning, it has had among the highest levels of dividend growth in the sector. So that the dividend CAGR for this trust over the last decade has been about 8.5%, which, as Dennis rightly says, basically means you double your dividend over 10 years if you get an 8.5% CAGR. That has been comfortably above the sector. And I think that's a reflection on how we run the portfolio and also and clearly the benefits of the structure, but that it is focused on companies that are capable of growing and focusing on growing that capital pool, and then the dividend comes from that. So I think there's one element that's just, it's UK equities and its outflows, and it's one element of, focusing on the dividend growth as well as just the dividend yield as an absolute number.
Brilliant. Thank you, Laura. And keeping a little bit focused on the trust for a moment, when we're talking about the UK, a focus point for a lot of investors has been smaller companies, which at present are offering a really good blend of yield, of dividend capital growth potential, but as you alluded to at the start, attractive valuations, particularly versus large cap counterparts. Given that flexibility that you and James have in fishing in that wider pool of opportunities, can you talk us through the breakdown of market cap for the trust?
Yeah.
And apart from house builders, which you've touched on already, perhaps dive into where else you're seeing value.
Yeah. So the breakdown for the trust, to start there, and I'm going to round it to sort of keep things simple. We have about 10% overseas. We have about 50% in the FTSE 100. And then the rest is split between the FTSE 250 and FTSE small cap NA. And it doesn't, to be honest, it doesn't necessarily matter. I don't think the split between FTSE 250 and small cap NA. That is the more domestic element. In terms of where we're adding, once you go below the FTSE 100, as I said, it has been some of the building materials companies, they tend to sit in the FTSE 250. The commercial property names quite often sit in the 250 as well. So we've added to things like Hammerson, which is shopping centres. So it just bought out the remaining stake in things like the Reading Oracle, which is where I spent most of my childhood years. One of those old traditional shopping centres that's actually seeing some really good levels of rental growth now, because there just hasn't been much built in that area. So the commercial property names also tend to sit in that mid-cap space, as do things like IP Group, which I mentioned, which was that sort of life science investor. So there's a breadth to it. And I guess I should be clear, we're not buying these companies because they sit in the 250. That's not how we run things. It's very much a case of we just look across the market for where we think the value is, and yeah, that happens to sit in the 250, that's fine, or it happens to sit on AIM. We're pretty agnostic about that.
I think that makes sense, and unsurprisingly, one of the hot topics and the themes this year has been AI. So this is a bit of a two-parter, perhaps one for you, Dennis, as well.
Yeah.
But Lord Debenture is exposed to some of those old economy stocks. So the first part of the question is, how will AI impact the future performance of those? And then when we look over to the IPS business, particularly the corporate secretarial services part of it, how will that be affected by AI going forward?
Yeah. So I'll start on the portfolio. If you think about Lord Debenture, the biggest sector overweight is industrials. And I think the nice thing about that industrial sector, and again, I have a simple mind, is that those things will still need to happen. So if you think about something like a Hill and Smith, where they're dipping things in zinc to stop them from rusting, this is things like lighting poles, benches, that kind of stuff. That will still need to happen. That will not get disintermediated. I feel pretty comfortable saying that. We will still need paving stones, we will still need bricks, we will still need consumables for steel, etc., etc. So in a way, being in that physical world, I think provides a degree of insulation. So I'd say that for the sort of older economy stocks, we do, to a small extent, I don't want to over-egg it, we do have a small amount of positive exposure to AI, if that's the right word, in that we have holdings like Ceres Power, which is effectively fuel cells that can be run off hydrogen, but will probably just be used run off natural gas for the time being, that can sit alongside a data center. So a lot of the problem, the sort of constraint in putting up data centers, is the lack of power and the lack of grid capacity in regions like the States. And actually something like a Ceres Power, which is just a licensing model, it's followed the sort of ARM model, so it doesn't produce them, it just licenses them out to its big partners, could potentially go alongside these data centers as one of the potential solutions for that kind of grid capacity problem. Again, I don't want to over-egg it. This is about 1.5% of the fund at the moment. It's not huge. But to the extent that the UK does have any kind of AI type stocks, and something like a Ceres would be in there. So I think that's how we're thinking about it from a portfolio perspective.
And to pick up on your question with respect to impact on professional services, my chairman, very wise man, has an expression: best to tuck in the peloton on this one. So there's no prizes for being out of the front of the peloton on AI, we think, and there's definitely not a prize for falling off the back of the peloton either. So what does that mean practically? It means that we're bringing all of our staff along and getting them educated and giving them courses on a weekly basis on how they can use various large language models that are available. And one of the places where there seems to be some momentum is something that within CSS is on minute taking, which I think you alluded to. So depending on the large language model and the agent, and again, we're still experimenting in here, but we are actually doing this with the help of our customers, and boards are generally very good at encouraging this as well. It can get you quicker to your version 1 of your minutes. It doesn't get you to a completed perfect set, but it means that, if you like, the company secretary's involvement is they get very quickly to draft 1, so they can focus their energies on using that. We talk to a lot of law firms in the course of what we do every day. It gets them to the first draft of the legal document, which might have taken them a day to turn out previously. They can now use their large language model to say, right, it's this type of standard contract. These are the main terms. I want you to be on this rating. I want you to be a 4, this one a 7. And it can produce you a first draft quicker, right? It just pushes the company secretary, in our case, or the lawyer in the case of law firms, it just pushes them further to the right, if you like, in terms of value impact, which is ultimately, what we've seen technology do to our businesses throughout the course of my career. And no different in Laura's career either. You instead of spending the time collecting the data, she spends way more time analyzing the data than she ever used to, which is the high value part of the work that she does. So yeah, very relevant. We're tucked into the peloton, and we're hopefully exploring it at an appropriate pace.
Fantastic. And maybe just keeping on the industrial point, Laura, that you've covered just now. We've had a couple questions and insights come through on a particular stock, which I think is in the UK industrial bucket of the trust, and that's Boku. So it would be really good to get a bit of an idea why that stock and that specific niche it fills.
I think it's one of these ones, it falls within the industrial sector, but it definitely is not an industrial company. It's what it does is my phone. If I don't want to pay for things with my card anymore, I can pay for things automatically via my phone bill. So this is things like Spotify, or paying for Apple TV or whatever it is. It's not so big in the UK because people have got used to using their cards, but it is very big in emerging markets that are skipping the card phase entirely, and consumers are going straight to paying for things via their mobile phone. And Boku is effectively the intermediary. It's got the relationships with the phone carriers that allows you to do that. So it just takes a very small percentage of a very high volume of transactions. So it's capital light in that sense. It's growing very fast. A pretty unusual company for the UK, actually. So maybe that's not the best thing that it's unusual, but it is growing very, very fast and profitable and all those kind of things. It's highly rated, but it is also high growth. The types of organic growth you don't often see from a UK business.
Brilliant. And now kind of pulling it a little bit wider field, clearly still very, very fresh. A lot to unpack, but after the budget announcement that we saw on Wednesday, unsurprisingly, that's a question. Have either of you got any thoughts on how this might impact UK companies or trust and IPS specifically?
Yeah, shall I go first for
please do,
UK companies? I mean, the main thing I was looking for out of the budget was that it would be non-inflationary. So I think the challenge with the budget last year, and it took us a couple of weeks to get there after talking to a few of our companies, particularly some of the retailers, was that the NICS charge, the national insurance charge that went on employers last year, cost a lot, to put it bluntly. And then you got that passed on over the course of this current year to the consumer, and it sort of got in the way of the interest rate cutting cycle. So the main thing that I wanted to see was that lesson had been taken on board and that this budget wouldn't be inflationary. Now, I think from what I've seen so far, I don't think it will be, but there are a few things, as is always the case with these types of budgets, there are always a few things that come out in the days after it, the details that people hadn't quite picked up on straight away. So the reason I say that is that the main question mark that I've still got in my head is business rates. So business rates is always pretty complicated to calculate. It looks like it might be coming down the road for hospitality in a way that people weren't necessarily calculating off the bat a couple of days ago. So there could be some price rises to come in hospitality, but I think for the most part, it is fairly non-inflationary. And what that probably allows from a UK economy perspective is that we will, in my view, we will probably see a rate cut in December and a few further rate cuts as we look out to 26.
And from the IPS business perspective, I think I'd pick up on one of the points that Laura mentioned there. Buried in page 895 of the notes, there's often something that could be material for one of our businesses. So I'd prefer to give a considered answer in a week or so's time. But what we do know is there are changes in pensions, right? And we're in a pensions governance business, so therefore there will be work that needs to be done on the back of that. But I would say, if it was to use the word neutral, right, so nothing spectacularly good or spectacularly bad, I would say for the business. And I think the point is over the last 8 years, and the world has thrown a lot of us at us in the last 8 years. COVID, no inflation, high inflation, coalition, Tory government, Labour government. We've run a portfolio of businesses. Our goal is, and we've achieved that mid to high single digit growth. There's nothing to suggest from Wednesday that we should get blown off that course.
Yeah, thank you both. And it's always a difficult one to answer because, like you said, Laura, it's often in the days and the weeks that follow that the finer details come to the fore. So no, but that does make sense. And just very conscious of time, so I'll chuck one more question, maybe split it into a two-parter your way. We've seen a pickup in M&A over recent years, and I think particularly for international buyers, that's a reflection on the valuation that the UK itself holds. So great to get your thoughts on that and whether you think it should continue at the rate it has, and also thoughts on prospects for IPOs.
Yeah. I mean, in terms of whether takeover activity, I think it will continue for as long as the valuation discount remains. So if you think the UK market is on about 13 times rounding, the US market last time I looked was on 22. So there is a very big discount there. There's also a discount that's less visible from public versus private. So often when I'm talking to some of these companies and saying, what other transactions are happening in your space and what valuation are they, it often strikes me that there is this quite stark discount between the public sphere and the private sphere. And actually often the public sphere, if I'm being honest, are, well, maybe I would say this, but they seem to me to be better run. They often are run more transparently with a better balance sheet, better invested in my view, and yet the valuations are lower. So I think for as long as that discount, there's discounts to listed peers, I think there's also discounts to private peers. So with those two things in mind, I think it will carry on. I think when it comes to IPOs, and it's funny, where people are very focused on IPOs, I think the same is true. As in, you have to assume that anyone that's looking to IPO their business is a highly rational actor. And if there's a higher valuation that they could get somewhere else, they'll go somewhere else. And that's totally within their rights to do that. So I think as long as that UK valuation discount remains, I think we will see a relatively muted UK IPO backdrop.
And if I could just add something on the M&A piece to support what Laura's saying there. I think I touched on this. One of our products is our escrow product. And we do that for M&A transactions. And a huge amount of US inbound into the UK, which Laura sort of touched on, a lot of mostly private money, mostly private equity money that's been buying in here. And I was in with one of the M&A partners, senior M&A partner, who's not prone to hyperbole at one of the major London firms 2 weeks ago, and he described the atmosphere as febrile, which I had to look up. But it's pretty frenzied at the present time. So I think as long as valuations, to Laura's point, as long as valuations stay where they are, and there's a lot of private equity money looking for a home for that money, then we would see that as a constructive environment for that.
Brilliant. Thank you, Dennis. And thank you, Laura, as well. We've packed a lot into that in the Q&A, which is great. So thank you so much for going over those answers, but also taking us through a bit of an update on the trust. It's been really, really great to have you on today's webinar. So thank you. And for those listeners that want any further information on Law Debenture, the team publish a really good range of materials on the website, both specific to the trust and its IPS business, but also broader market insights. So I'd really encourage you to all check that out. But with that, I'll wrap up by saying thank you again to Laura and Dennis for joining us today, and for all of you who've dialed in this morning as well. Take care. Bye-bye for now.